This video describes several commonly used financial ratios for analyzing profitability. Profitability analysis evaluates whether the managers are effectively executing a firm's strategy. Rate of return ratios integrate information from income statement and the balance sheet, and the two most widely used profitability ratios are return on assets or ROA and return on common equity or ROCE. The rate of ROA measures a firm's success in using assets to generate earnings independent of the financing of those assets. Thus, ROA is unaffected by the proportion of debt versus equity financing and the cost of those types of capital. ROA is calculated using the following equation. The numerator of ROA adjusts net income to exclude the effects of any financing costs. Thus, the measure of profits pertinent to ROA is net income before financing costs. The second adjustment to the numerator, that is adding back the non-controlling interest in earnings, relates to attaining consistency in the numerator and the denominator of ROA. The denominator of ROA includes all assets of the consolidated entity, not just the parent company's share. However, net income in the numerator represents the parent's earnings plus the parent's share of earnings of consolidated subsidiaries. Consistency with inclusion of all of the assets of the consolidated entity in the denominator of ROA requires that the numerator include all of the earnings of the consolidated entity, not just the parent's share. The add back of non-controlling interest in earnings accomplishes this objective. You might have also noticed that we use the average total assets in the denominator. This is due to the fact that the numbers in the numerator comes from income statement that summarizes a firm's activities during the entire financial year, while the total assets comes from the balance sheet, which presents a snapshot of assets and liabilities on a given day. So for the numerator and the denominator to be consistent, we use average total assets in the denominator. The average total assets is the average of total asset at the end of the current year and at the end of the previous year. A general rule of thumb: whenever we combine numbers from income statement or the cash flow statement with the numbers from the balance sheet, we always take an average of the numbers coming from the balance sheet. One can obtain further insight into the behavior of ROA by disaggregating it into profit margin for ROA and asset turnover components as shown in the following equation. The profit margin for ROA indicates the ability of a firm to utilize its assets to generate earnings for a particular level of sales. Asset turnover indicates the ability to generate sales from a particular level of investments in assets. In essence, the asset turnover ratio indicates the firm's ability to use assets to generate sales, and profit margin for ROA indicates the firm's ability to use sales to generate profits. ROA measures the profitability of operations before considering the effect of financing. That is, ROA ignores the proportion of debt versus equity financing that a firm uses to finance the assets. Return on common equity, or ROCE, on the other hand, measures the return to common shareholders after subtracting from revenues not only the operating expenses such as cost of goods sold, SG&A, and income taxes, but also the cost of financing debt and preferred stock. The numerator measures the amount of net income for the period available to common shareholders after subtracting all amounts allocable to non-controlling interest and preferred stockholders. The accountant subtracts the interest expense on the debt in measuring net income, so the calculation in the numerator of ROCE requires no adjustment for debt holders' claim on earnings. The denominator for ROCE measures the average amount of total shareholders' equity in use during the period. We take the average of total shareholder equity to be consistent with the numerator. The numbers in the numerator comes from the income statement, while the shareholder equity comes from the balance sheet, and as already described previously, we always take the average of the numbers coming from the balance sheet whenever we combine information from income statement and balance sheet. Now that we have discussed the details on calculating ROA and ROCE, let's consider the relation between the two ratios. Specifically, consider the situations under which ROCE will exceed ROA and the situations under which ROA will exceed ROCE. Can ROA be ever equal to ROCE? Please review the text to understand these relations. We can disaggregate ROCE into several components to aid its interpretation, just like we did with ROA. The disaggregated components of ROCE are profit margin for ROCE, asset turnover, and capital structure leverage. Note that the first distinction between profit margin for ROA and profit margin for ROCE is the different numerators used. The numerator for profit margin for ROCE is the net income available to common shareholders, while the numerator for profit margin for ROA is the net income with after-tax interest expense and controlling interest added back, which yields a measure of profit before deducting financial costs. The different numerators are aligned with the different denominators, common equity for ROCE and total assets for ROA. Asset turnover is identical to that used to disaggregate ROA. The additional component in disaggregation of ROCE is the capital structure leverage, which measures the degree to which a firm strategically utilizes financial leverage to finance assets. The difference between the numerator and the denominator of the capital structure leverage ratio is the amount of liabilities in the capital structure. The larger the amount of capital obtained from the debt and preferred stock, the smaller the amount of capital obtained from common shareholders, and therefore the larger is the capital structure leverage ratio.